Hello there, Leandro Guerra speaking. Welcome to the Outspoken Market. And in today's class, I want to give you an intuition about option mathematics, more specifically with the Black-Scholes-Merton model that I know even if there are some criticisms around it and many participants in the market, they don't use that. My point is that if you understand its foundations, you are going to understand anything else because options, they are extremely dynamic. The market is extremely dynamic. Many things are changing at the same time, like the time that it's passing, the price of the stock itself, the volatility. There are many attributes that will be compounding the schematics of the option price happening at once. However, if you understand these pieces individually, you will have a very good understanding on how eventually you would measure your risk and potentially any kind of actions or decisions that you are going to take when trading options. Now, the main foundation and the core assumption is that the BSM assumes a geometric Brownian motion. Okay, there is nothing really new over here. So we have the understanding that the price movement is compounded by a drift and by the volatility itself. So the drift is represented by mu and the volatility by sigma. And the price follows a random walk, a normal random walk. And the intuition, the first one, is that we want to understand possibly what would be a fair price today for the right to buy or sell something in the future. So this core point is what, if you put in your head, you are going to clearly see what is coming next. Now, from the derivation of that assumption up to the whole mathematics that compounds the creation of these formulas, I don't want to break it down on how we get to this, maybe in another class. What I want is that you look at it and then you can quickly understand what is happening over here. Well, here we are speaking about an European call and put prices formula. The European option, essentially, it's the one that you can exercise your right of buying or selling only at the expiration. And essentially, they are compounded by a maturity T and a strike K and some other few elements that we are going to understand. So here C, it's the call option, and P, it's the put option. Now, the formula is the stock price represented by S, Q are the dividends, T, it's the time to maturity, usually in days. Then we have K, that it's the strike price. Then we have R, that is the rate free of risk, usually the US bonds or something like that. And a couple of fellows over here, that it's DN and the D1 and D2. Now, DM, it's a statistical formula that essentially gives you the probability of an X being equal or lower than a given value. So you can understand as a probability that will be always something between 0 and 1. And think about the following. Now, if we have a couple of stocks, different ones. So we have stock 1 and the stock 2 over time. If one stocks move like that and the second one moves more aggressively without making the judgment whether if they are going up or down, clearly we can see that the volatility sigma on stock 1, it's lower than the volatility in stock number 2. Therefore, will be eventually riskier to have or to hold or to trade is stock number 2 because the price will move more widely than the first one. And this will be implicitly represented by the option price. Follow me on that. You're going to see that it's beautiful. Now, D1 and D2, they are given by this couple of formulas over here. And besides the strike price, that it's K, and the stock price itself, that it's S, you see volatility and the time to maturity are represented in both numerator and denominator of each one of the formulas. Let's first stick with the volatility. Let's assume stock number 2, which the volatility is way higher, or the volatility might be growing over time. If volatility grows, now the denominator value it's going to grow, assuming all the rest it's kind of constant. If that happens, well, one may say that the D1 is going to come down. However, in the numerator, we have a squared volatility times the other components. Therefore, the final outcome is that D1 also goes up when the volatility goes up. Please, it's a simplification so you can easily understand its dynamics. If D1 goes up, that component over here, it's also going to be up. Because if the dividends, it's eventually 0, then that component over here will become 1, and then I have the stock price multiplied by ND1. If ND1 goes up, that 1 being constant, we have also an increase in the call option price. If volatility goes up, as we said, eventually D2 is going to go down, because in this scenario, the volatility is subtracted from the other components of the formula. That final component over here, that is led by the strike price and the interest rate plus the time as well, eventually gets a little bit lower. So you have a more effect on what you are gonna get from what eventually you are gonna pay on each one of these components. So the overall combination over here is that volatility going up, you are going to have an increase in the call option price. You can follow the same intuition for the put prices, but for simplicity, we are going to stick to the call option one. That it's great, which means the following. After a turmoil in the markets, on which the volatility is high or became higher than it was before, and after that turmoil, if we expect a time of a little bit more calm waters, that will be a very good time for you to sell the option, because you have fat being added to it after that volatile period, and that it's why we say that it's a good moment to sell an option. In this case, you may have a covered sell and whatever you think it's appropriate based on what you are going to do. So this is one of the intuitions regarding the volatility. If you will look to the time to expiration, the T, the higher it is, higher naturally it's the stock, the call price as well, because we also have here in the numerator and in the denominator, and eventually they are going to be compounding more or less, but with less effect than the volatility itself, that it's squared. Now, if the volatility is high, or in this case, we are going to assume that it's constant because we are speaking about the time to expiration T, What happens when we get closer to the expiration date? When T is really, really low. Do you agree with me? If T is really low, since it's multiplying everything that we have here into the parentheses, this eventually gets closer to zero, so it will be neglectable regarding the component of the price over the strike. And since T it's getting really, really small because we are approaching the expiration date, the denominator gets really low, increasing the D, 1, but what factors eventually would be the price over the strike, compounding the call option. That is the reason that the closer you get to the expiration, the movements in the price are going to be extremely aggressive and driven by the proportion you have between the stock price and its strike. Of course, volatility plays a role as well and will be balancing, but this is getting closer and closer to zero. So you imagine what happens to D1 and also with D2, that it's potentialized by the fact that this also goes neglectable regarding the rest, and you have therefore the price movingly essentially based on the difference between the price and the strike. Why this intuition about volatility and the time to expiration is so important? Because that help us to understand the main Greeks, the small components or the subparticles of the model that helps to drive the price of the options as well. Now, we have two of them essentially. Vega, that it's not necessarily a Greek letter in this case, but we can say it that this is the measure of the impact of the volatility in the option price itself. We have gamma, and then we have both theta for the call and the put options. Vega and gamma for the call and put are the same formulas, and for the call and put thetas we have a small difference compounding from this minus sinus over here and this plus against the opposite for the put. In the very same way, if my time to expiration is passing, so it's like the clock counting against you, the option price loses value because you see there is this minus sign over here. So the component that will help the option price lose value, it's accelerated by the fact, for example, T, it's decreasing. It happens the same effect on the denominator that we have seen in the previous page. You follow the same intuition for the volatility as well. As the time is passing by, those things compounding together, everything is subtracting value from your option. That is why the longer you stay and eventually no price movement happens, the value of the option starts to shrink. And if you bought that option thinking that something would happen, well, eventually you will lose money. You will lose how much you have paid for that particular option. So that's why understanding when they are expensive and when they are cheaper, given the volatility effects on it and the time of expiration, helps you to decide when it's a good time to position itself for a structured operation like a long straddle or a short straddle, for example, in this case. Particularly if you will look back to the gamma, and here actually it's a times sign. If the time to expiration gets really small, eventually what drives the price of the option, it's the movement in the mother asset, in the stock price itself. That's why we say that it's closer to expiration. It has only gamma. Eventually, how much the stock price is gonna change, it's eventually how much the price of the option itself it's going to change. So it's beautiful. I mean, everything turns out perfectly. Of course, these in the end of the day, they are going to be approximations. You may have some error margins for that, given, I don't know, operational costs, spread, slippage, and other factors. So when you are approximating your calculations through this formula, you may expect about 5 to 10% error margin on the calculations itself. That if you are a private investor, an individual trying to do something, it wouldn't affect you that much. If you are, of course, a fund manager doing something much more structured, this may be huge, and there will be other components for you to evaluate as well. But my point is, these effects that we have studied, they're going to be the same everywhere. And then the job, it's okay, trying to get something much more accurate and to get lower and lower error margins for these particular points. But the message, it's how that intuition happens, how we can expect the changes and the shifts in the option pricing coming from the main factors that will affect it: volatility and the time for expiration itself. It's pretty nice, isn't it? So when you get to see particular that view, and if you get back lastly for the Vega, if the time to expiration is really small, you see that the volatility in the end of the day does not matter that much, because this will bring all of these components essentially closer to zero. So what we will drive pretty much the price of the option close to the expiration, it's going to be the gamma and the price itself, as we have seen. Hopefully this lesson has helped you to have a very good understanding. In the next one, we will be covering particularly the volatility component, because we have seen that this volatility is what has been measured by the market. But we know that in options, the market participants eventually would imply a volatility, would price a volatility given the risk that they are foreseeing or predicting to happen in the future. But it's the subject for the other class. Thank you very much. See you next time. Take care. Bye bye.